They are looking that in pilot the economy. Let me say that they are looking to the consumers and where consumers stay. Consumers' confidence was slightly down here, and we won't go into the rest of this. UK sales up 0.2 in August, but let's very, very quickly here look at a little bit of market data today, and we always look at this on our weekly report, and we'll sketch it very, very quickly here. A lot of red ink here. The BBC Global 30 was in the negative 55.42. The FTSE at 42 point, the FTSE 100. We'll do FTSE all shares at 19.01 in the negative there. In Amsterdam, they were at 0.87 in the negative. Also, the DAC was at 2.37. In Paris, they were at 9.30. In Brussels, they were in a negative 12.99. In Madrid, 129.80. In Zurich, they were also down. They were down, 18.69. In Moscow, this is all Thursday unless otherwise noted, 4.39 in the negative. In Johannesburg on Friday, 294.82 in the negative there. In Bombay, we got it on Wednesday, 107.27. On Thursday, out of Karachi, 261.46. Lahore, 40.62. Colombo, 23.86. All these in the negative, incidentally. And finally, on Wednesday, out of Tehran, a negative 272. There, and in Sydney on Thursday, 46.60. The Nikkei was at 260.67. The Hang Seng was down 112.03. And in Shanghai, they were also down 66.20. In New York, they were down today at 65.21 in the negative. The Nasdaq was at 4.17. The Merc out in Chicago, the commodities market was down 5.11. In San Pablo, 1,189.03 in the positive, and also in Mexico, 442.27. A very quick look at commodities here. Brent crude was down 61 cents, resting at $49.14. The spot was up 35 cents at $49.56. West Texas Intermediate was down 18 cents at $46.80. I saw someplace there was literally a gasoline at $1.99 a gallon. Don't know where it was right now. The Forex on gold was up $98.40 at $1,118.50. Dubai Gold Futures, that's the Forex Gold Index, it was up $15.20 at $1,118.50. Silver was up 25 cents at $14.76. We'll look real quickly here at corn futures. This is a CBOT down $6.25. The Euronext Life futures, cocoa was up $8. Corn futures down $2.55. We won't go into much of this. Robusta coffee down $36. And the Bloomberg Commodities Index was down 0.43. It was on Thursday. So this will do it for our special report. We'll see you on the week that was this weekend. Good day.
Appropriate trajectory would be lower and less steep. Finally, the committee will continue its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. The committee's sizable holdings of longer-term securities should help maintain accommodative financial conditions and promote further progress toward our objectives. Thank you. Let me stop there. I'll be happy to take your questions.
Steve Leisman, CNBC. Madam Chair, this notion of uncertainty and economic and global developments, is it fair to say that it could be many months before those global developments work their way through the U.S. economic data, and that you would not have the certainty that you're looking for to raise interest rates for many months and perhaps well into next year?
Well, Steve, I think you can see from the SEP projections that most participants continue to think that economic conditions will call for or make appropriate an increase in the federal funds rate by the end of this year. 4 participants moved their projections into 2016 or later, but the great majority of participants continue to hold that view. And, of course, there will always be uncertainty. We can't expect that uncertainty to be fully resolved. But in light of the developments that we have seen and the impacts on financial markets, we want to take a little bit more time to evaluate the likely impacts on the United States. And as I mentioned, the inflation outlook has softened slightly. We've had some further developments, namely lower oil prices and a further appreciation of the dollar, that have put some downward pressure in the near term on inflation. Now, we fully expect those further effects, like the earlier moves in the dollar and in oil prices, to be transitory. But there is a little bit of downward pressure on inflation, and we would like to see some further developments, and this importantly is likely to include further improvements in the labor market that would bolster our confidence that inflation will move back to 2% over the medium term.
Sam Fleming from the Financial Times. Could I ask about the next meeting, which is in October? Do you view that as a live meeting, even though there isn't going to be a scheduled press conference at that time? And what kind of developments would you need to see to be confident in moving in the near term? Is it more important, the developments in the financial markets, or is it more to do with the upcoming data? Thanks very much.
So, as I've said before, every meeting is a live meeting where the committee can make a decision to move to change our target for the federal funds rate. That certainly includes October. As you know, and I've stressed previously, were we to decide to do that, we would call a press briefing, and you've participated in an exercise to make sure that you would know how to participate in that press briefing should it happen. So, yes, October, it remains a possibility. And we will be looking at incoming developments, both financial and economic, to try to make sure we feel really that the U.S. economy is doing well. You know, I want to emphasize domestic developments have been strong. We see domestic demand growing at a solid pace, the labor market continuing to improve. Of course, we will watch incoming data to confirm our expectation that that will continue. And we, of course, will watch global financial and economic developments. I can't give you a recipe for exactly what we're looking to see, but as we say, we want to see continued improvement in the labor market, and we would like to bolster our confidence that inflation will move back to 2%. And, of course, a further improvement in the labor market does serve that purpose. There could be other things we would see that could bolster that confidence, but further improvement in the labor market will serve to do that.
We'll go to Jen, and then we'll go over to Kate.
Hi, Jim Pusengarra from the LA Times. There were a group of protesters out here before your meeting. There was a similar group at Jackson Hole. They and others have warned the Fed not to raise the rate because out of concern that the labor market is not fully healed, wages haven't risen fast enough. What impact, if any, has that had on you and your colleagues in your decision today?
So we have been receiving advice from a large number of economists and interested groups, and that's, of course, appropriate, and we value hearing the opinions of many different groups and individuals with different perspectives. But look, at the end of the day, it's the committee's job to come together to analyze the data that we have on the economy, to decide how it affects the outlook, and to try to deliberate and arrive at a committee judgment about the appropriate path of policy. And that's what we did today. As I said, although we're close to many participants and the median estimate of the longer-run normal rate of unemployment, at least my own judgment, and this has been true for a long time, is that there are additional margins of slack, particularly relating to very high levels of part-time involuntary employment and labor force participation that suggests that, at least to some extent, the standard unemployment rate understates the degree of slack in the labor market. But we are getting closer. The labor market has improved. And as I've said in the past, we don't want to wait until we've fully met both of our objectives to begin the process of tightening policy, given the lags in the operation of monetary policy.
Kate and then Binion.
Thank you. Kate Davidson from the Wall Street Journal. Madam Chair, do you think over the past 2 months since your last meeting that you've gotten closer to or further away from the Fed's inflation goals? And then separately, you've received a congressional subpoena relating to the disclosure of information from the Fed's September 2012 policy meeting. Are you any closer to complying with that? Have you turned over any new information to Congress?
So your first question was, have we come closer or move further away from our inflation goal? So we've used the same language, which is that we expect to achieve our 2% goal over the medium term. And I would say, although as we say in our statement, recent developments seem likely to put some downward pressure. We're, after all, way below our inflation target. But an important reason for that is that declines in import prices reflecting the appreciation of the dollar and declines in energy prices are holding down inflation well below our target and well below core inflation. We expect those effects to be transitory, and with well-anchored inflation expectations, we expect inflation to move back to 2%. Now, in the intermeeting period, we have seen some further appreciation of the dollar and some further downward pressure on energy prices. And that creates a bit of further drag on inflation that I would view as transitory, as very likely to be transitory. So I continue, and the committee continues to expect that inflation will move back to 2%. So this should be a small thing. And in the meantime, the labor market has continued to improve. So a tighter labor market, a labor market moving toward full employment, is one that historically has generated upward pressure on inflation. So that bolsters my confidence in inflation. On the other hand, we've had a long period in which inflation has been running below our objective. I consider it, and the committee does, very important that we achieve our inflation objective and defend against inflation that is persistently above our inflation objective and also persistently below our inflation objective. And we want to have not only an expectation but a good degree of confidence that that will occur. We did take note in the statement of a decline in inflation compensation, and it's hard to get a direct read on inflation expectations out of these measures. They can